The US dollar is near a 13-year high against the Kiwi dollar, which makes investing in the US market extremely costly for Kiwi investors. So what should you do? This video explores why the exchange rates are so high at the moment and looks at possible options for investors, including whether or not you should use a currency hedged investment. Why is the US dollar so high and why is your Kiwi dollar so worthless? The simple answer is inflation. Now, everything seems to be related to inflation these days, but how does that actually affect the currency exchange rate? Well, my friends, let me try to explain. The annual inflation rate in the US is at 8.2% from the latest September report. Now, because the inflation rate in the US is so high, the Federal Reserve keeps on increasing the interest rate in an effort to slow down the inflation. Last time the interest rate was increased by 75 basis points. Now, this gives a current interest rate in the US of just above 3%. The Fed is obviously doing this in order to put a stop to inflation. Now, they also gave hints that they are not afraid to push the economy into a potential recession. But what happens is that when the interest rate of the US dollar is high, people would want to exchange from their local currency to the US dollar for the high interest rate. It's like if a bank offers a higher interest rate, people will want to put money with that bank. And currently people want to put money with the bank of the US dollar. Secondly, there's political instability and a large amount of uncertainty in the world with the conflict still ongoing in Eastern Europe. There's also the potential of oil shortage due to sanctions and supply chain issues. These geopolitical issues make people want to hoard what is considered a more of a stable currency, which at this moment is the US dollar. A combination of these factors serve to make the US dollar currency at a multi-year high compared to other major currencies. Now, this effect is shown in the US dollar currency index, the DXY. The DXY index shows the relative strength of the US dollar compared to other major currencies, and it is close to a 20-year high. How does this affect your investment? As a foreign investor for the US market, you are subjected to both fluctuation in the currency exchange and also fluctuation in the market itself. If you are from New Zealand and invested in the US S&P 500 and it's down by 20%, but the US dollar is very strong and is up by 20% to the New Zealand dollar, you would end up with 0% loss or gain because they serve to cancel each other out. From the beginning of 2022, the S&P 500 dropped by around 20%, while the US dollar has gained around 20% against the New Zealand dollar. Effectively, the losses from the market gets countered by the gains in the US dollar currency. A common question that gets asked is, should you hedge your investment? There are certain funds that hedge against currency exchange so that these funds are not as affected by the different currency fluctuations. Using the same previous example, if you use a currency hedged fund for S&P 500 and the market goes down, you'll still end up losing 20% when the S&P 500 is down by 20%. But you would miss out on the gains from a strong US dollar currency. On the flip side, if the S&P 500 goes up by 20% and the US dollar goes down by 20%, using a hedged fund, you'll benefit from the 20% gain from the S&P 500 without the downside of losing value in the currency. Basically, currency hedge funds help in certain situations and doesn't help in others. So unless you know exactly what's going to happen in the market in the future, it's simply not possible to decide when you should actually use a currency hedged fund. Furthermore, there has been no studies that have been able to definitively prove that currency hedged investments are more beneficial compared to a non-hedged investment. With that being said, there is one potential difference between hedged funds and non-hedged funds. Hedged funds quite often tend to have a higher management fee compared to a non-hedged fund. An example would be the popular Vanguard International Shares Index Fund offered by InvestNow. The normal version has a 0.20% management fee and the Hedge version has a 0.26% management fee. Now, if we look at the returns of both, we actually see that the normal unhedged fund slightly outperforms the hedged fund, even though both of the funds invest in exactly the same companies. Exchange rate for currencies tend to fluctuate over the long term, so the effects tend to average out over time. Now, trying to find the best exchange rate and also invest at the bottom of the market is an impossible task. So is there any time that you should actually consider using a hedged fund? Now, under normal circumstances, the only time that you would really want to use a hedged fund is when you are sure that either the US dollar is going down in value or that your home currency is going up in value. But trying to predict currency movement is almost impossible at the best of times, despite how online trading gurus would have you believe otherwise. However, there is one thing to consider. For example, currently the British pound is at a historical low against the US dollar. And because it's at a historic low, there's a high probability that it'll go up compared to it keep on going down. Therefore, if your home currency is at an historic low compared to the US dollar, it may be worth picking up a currency hedged fund since you'll have a much higher potential upside. If you do want to invest in currency hedge funds in New Zealand, there are three potential options. The first is the previously mentioned hedge version of the Vanguard International Shares Index Fund that you can invest with InvestNow. The second option is the hedged version of the Smart Shares Total World ETF with the symbol TWH. The Smart Shares Total World ETF is a repackaged version of the Vanguard Total World ETF. You can find that in Sharesies or directly invest with Smart Shares. The third option is the hedged version of the S&P 500 fund from Kernel Wealth. Like what the name says, the fund invests in the US S&P 500, hedged against currency fluctuations. After all of that, if you are still wary of high exchange rates, but also do not want to invest in currency hedged funds, a very simple alternative is simply don't invest in the US market for the time being. Consider investing in markets in Europe or Asia or New Zealand or Australia when the US exchange rate is not favorable. Now, while these markets are much smaller than the US market, there's still many good companies that you could invest in. Check out my videos here on the reviews of different platforms that you can use to purchase these investments, including the best platforms to purchase companies in Australia.